commute to the broadcast for the New York finance group. My role is to introduce you to a great subject and a great host of speakers. Let me begin with the subject: what is next for the markets? You read the disclaimer before. No one here is going to pontificate about the next move of the market, but they will give you some insights from what they're experiencing in today's very unusual times. Let me introduce the monitor, Karl Moore. He's an associate professor at Des Hotels Faculty of Management. He has actually worked in the tech industry for many years, over a decade in sales and marketing, and he has taken his experiences to teach many of us on this phone perhaps over time. He teaches at various executive educational institutions around the world that are well recognized, and he's a name on his own. He's taken those learnings and written many books. He's actually on his 11th book, which he clearly has a lot of free time. His topics are introverts, extroverts, ambiverts, which are the mixture of the two in leadership in the C-suite. He's a big contributor to Forbes and does a lot of other things around McGill. And thank you, Karl, for moderating this. The two speakers, again, McGill grads and very committed to McGill. Brad Marshall, he is an MBA grad, almost 20 years of experience. It's actually 20 years ago he graduated for our great school. He's a senior managing director at Blackstone. He oversees Blackstone's direct lending effort. He previously worked at Royal Bank of Canada and TAL Global. The next speaker, a person that I work with actually in my other responsibilities, Russ Chong. He is co-head of Citibank's equity capital market business for the Americas. He's got 20 years of experience in banking, both investment banking and equity capital markets. And both of these gentlemen serve on the executive members, as executive members on the New York Finance Group. With that, I will turn it over to Karl, and thank you, Karl, again for moderating this event.
Well, thanks, Mark. Appreciate your comments. And Mark's up north in Mount Tremblant, so we get to see Mark and his family from time to time. And I had the pleasure of teaching his youngest daughter about 3 years ago twice. So just it's a very impressive family. One really enjoy their contribution to McGill over the many years. And so I remember Brad as a student a while ago. So it's something where he just even looks more handsome and just wiser than he did 20 years ago. So things have improved. Didn't have the pleasure of teaching Russ or Mark, but a little bit before my time. So let's start off with the first question is, how does this crisis compare to other financial crises that you've seen and worked and experienced through? So 9/11, 08, and so on. Let's start off with Brad on this one.
Sure. Thanks, and thanks for hosting this. I think it's a great event, and I think the title of how to think about retirement, hopefully I'll get some tips from the other panelists, because I'm curious about that as well. You know, when we thought about this topic, I was talking to one of my colleagues, and he gave me a great quote, which I'll share, and it was from Vladimir Lenin. I said, there are decades where nothing happens, and there are weeks where decades happen. And I think that's clearly kind of what we've experienced over this short period of time. Listen, I think we're all going to, I think, probably say the same thing. This is, you know, clearly an unprecedented time, and one that, you know, is a period where the U.S. government or the U.S. economy basically voluntarily shut down. So really hard to kind of compare the two, but I think when we look at the .com, you know, period, and when we look at the 08-09 crisis, I think what's interesting to us is that the length of time that it took to go from, you know, the beginning of the crisis to the trough, and then the trough to recovery, and both of those are very long periods of time. So I think in the .com it was 27 months. From beginning to trough, and then the recovery was about 14 months. In 08-09, it was 15 months beginning to trough, and then 23 months trough to recovery. And I only point that out because as you think about, you know, both of those were very different crises, driven by excesses and financial issues. This one, obviously, it's a supply shock, a demand shock, a financial shock. It's all those things. But I point that out because as we think about bigger issue or question around retirement, both those crises took a long time to play out. So it does feel like we're in the middle of it. And it does feel like, despite what the equity markets say, we've got a kind of long road to go, despite these crises all being very different.
So Russell, what analogies, what things come to your mind based on your 20+ years?
So again, like Brad, thank you, Professor, for putting this together and having the opportunity to speak. I think it's a great idea and pleased to be a part of it. Listen, I agree with a lot of what Brad said. I think when I contemplate what is the most analogous, I think of some combination of 9/11 and the financial crisis of 08 through 10 and beyond. And just taking a step back, the way I look at what is happening, it is a health crisis that has become an economic crisis, the scope of which we're still trying to figure out, which could have quickly become a financial crisis and may still become a financial crisis, but it has become certainly a cause of financial concern. And the policy responses, both in the US, at least from the Fed and the Treasury and the administration, I think they learned from the credit crisis and moved swiftly to staunch some of the bleeding that I think that they didn't do in the 08-09 timeframe. But to go back to 9/11, why I think it's analogous in some regard is because this was an event-driven shock, one that was not seen just like what happened on 9/11. The massive difference between 9/11 and the health crisis is 9/11 was localized. This is a global shock, and it is happening all at once, and it's caused almost a cessation of economic and commercial activity, not only in North America, but globally. And so that is, I think, the one parallel between now and then. I think the difference, though, because it's global, and as we move into the economic, and we don't know, for instance, the debate is going to be, is there going to be a resurgence? Is there going to be another bolus of infections? Is that going to happen in the fall? And then what is the economic impact? And so when I think about the credit crisis, while the US banks, and listen, at the end of the day, there's a reason why the markets have retraced half their losses and financials are still down 25%, including the banks, including my own firm's stock, is because at the end of the day, whether it's mortgages or other things, this will become a financial issue, and no one's quite sure where it will end. And so that's where I think the parallels are. And I do feel comfortable more than I did in 08, simply because of the policy responses and the fact that at least the US financial center banks are much better capitalized and also have been managing their books and their risk exposure in the last 10 years in a different way. Because that doesn't mean we're out of the woods. Now the real question becomes, are we going to have anything curative on the therapeutic side? Are we going to have a vaccine? Because ultimately, this is a health crisis. And I think what most governments are trying to, well, I shouldn't say most, but a lot of the Western democracies are trying to do whatever they can on the policy front to make sure that we have an economy that we can resuscitate at the end of this, rather than one that we have to rebuild. And the real question is, how much debt are we willing to put on the Fed's balance sheet?
Mark, this one question, I want to bring you in just because you have a little bit more experience than Brad and Russ. What comes to your mind when you think about this crisis? What parallels do you draw on from your experience to help you manage better?
Well, a couple of things come to mind. Firstly, just the interconnected nature of all the various countries in dealing with this, obviously in different ways. The government's involvement, if you look at the pattern over time, they're so quick to react to have to be the stopgap. The U.S. government alone, whether it's the Fed working with Treasury, it's never been seen so quickly coming to a place where they put basically $7 trillion of stimulus into the market, and they're even talking about another stimulus package as we speak now. I do think that the markets are interesting because the markets have behaved in very different ways. You have the U.S. really, as Russ was saying, really recapturing a lot of the from the panic, from the trough, regaining back and being down. NASDAQ is actually up year to date. Who would ever know that? We won't go into what makes sense for the moment, but that's a pretty interesting belief in tomorrow. From the standpoint of Europe, Europe is down 20–25% still. Asia has recovered somewhat. It's still lagging what the US is, but it's interesting from the standpoint of the connectivity of each of these regions and how they're reacting differently for different reasons. So there's opportunity in that also. As people think about retirement, it isn't necessary to go to savings, because savings doesn't provide you any return. It is, where do you put, what asset class do you go to, where your risk and reward is, what period of time in which you're willing to invest. But I would say in this situation, as Russ really said well, is the government is totally involved in getting this to a place where we can recommence an economy that's connected.
I'm generally, happy to hear that you guys seem that the U.S. government seems to be doing a reasonably good thing. Am I reading too much into that? Like, you seem, hey, the government, Russ, you were saying the government seems to be making the right moves in an uncertain world.
Yeah, I would say, listen, there are costs to everything. And I'm not sure the long-term costs anyone's well aware of, and Professor Moore, you probably might have a better view than I would. But I would say the policy objective and the priority, it's been clear out of Washington, is to take care of the short term. And I don't want to say it's damn the torpedoes, but I think that it's figure out the short term. And listen, part of it is politically motivated. There's an election this year. But I do think the reference I was making to the credit crisis was there was a lot done there to help bridge what was happening. And I just think the lessons learned that they've done. So, I mean, are there things they could have done better? Yes, perhaps. I just think the swiftness with which they've moved and the willingness for them to do both do monetary and fiscal stimulus, I think, has been recognized by the markets. And I think that's one of the main reasons why the equity market is trading like it is.
But Russ, it's fair to say, oh, sorry, go, Brad. Apologies.
I was just going to add that, the one thing, and I gave those stats at the start from kind of time to trough and time to recovery. I think what's different this time is exactly, this topic, which is that the Fed fired a giant bazooka in the first couple of weeks of this crisis. And they took everything they learned in the great financial crisis over a year and applied it within 2 weeks. So that had a huge impact on stabilizing the markets. And I would say the one, I guess, positive or negative is that it did put a little bit of floor on the market and continues to put a floor on the market, such that the technicals right now are way ahead of kind of the fundamentals, which I'm sure we'll talk about later. And again, that's positive because it allows capital to come into these asset classes, especially the riskier asset classes.
We want to do a short poll to see where people are from, where they are from. So we'll put that poll up. Sam Marie, if you could be so kind. So we'll give you 30 seconds or something to let us know roughly where you are, and we'll just get a sense of the audience we have with us today. I was scheduled to take students to Vietnam and Seoul at the end of February for our 12th annual Hot Cities of the World Tour. And so I know from taking students all over the world, South Africa, Asia, Russia, South America, we have McGill alumni all over the world. It's a very, very impressive group indeed. So Anne-Marie, if you have the results of the poll.
It's like 80% Canada.
Oh, okay, interesting. So Anne-Marie, if you'll unpause us. So get to the second question. Russ, you deal with CEOs quite a bit. So the question is, you interact with a lot of CEOs in private companies. What are their views with respect to their own business, and how they're going to make the way forward from here?
I'll answer that generally and then try and go in a little bit. Well, let me put it this way. I think it really depends on what industry that CEO's in. I would tell you what's ruling the day is uncertainty. And all you have to do is have been witness to the earnings reports for the first quarter, where swaths, something like 60% of the companies either withdrew or certainly curtailed their guidance for 2020. It was the CFO of Johnson & Johnson who in the Journal about a month ago said, I'm paraphrasing, he said something like, whatever I say about 2020 guidance on my first quarter earnings call, I'll guarantee you one thing, it's going to be 100% wrong, right? And he was quoted as saying that. And I think what CEOs are doing and thinking about, I think, is best explained by what we're seeing, and I'm sure Brad can comment and Mark can comment, on what we're seeing in the markets, right? And what we've been seeing in the last 4 weeks is, or last 7 weeks, is this husbanding of liquidity, whether it's asking for emergency liquidity lines for those companies in the first or second derivative order impact of COVID, whether it's going to the bond market, first in the investment grade, then the high yield market, to shore up liquidity. And I think what's very interesting, what we're seeing, at least in my market, in the equity market the last couple of weeks, is rather than you have the liquidity transactions for the cruise lines and the airlines and the hospitality and the REIT companies, we're seeing more offensive transactions. We're seeing companies whose stocks are trading very well, whose liquidity positions are strong, and yet they're lining their coffers because I think two things, if you read into the implications of what they're doing and their boards are thinking, I think they think there's much more downside risk the next couple of quarters than there is upside risk in the equity market, to Brad, what Brad was intimating. And so they know that debt capital will be there in a few quarters, but if they want to be offensive strategically and they believe that some of their M&A targets may be dislocated in the future, you're starting to see strong companies who do not need to issue equity, and we all know that's the most expensive form of capital. They're doing it because they're not getting penalized in the equity market for raising it, and that's a definite pivot that we've seen in the last 2 weeks. So what does that mean for how CEOs are thinking about it? CEOs know, just like we've been talking about, they know more. They don't know much more than we do. When you talk about supply chain, when you talk about second and third derivative impacts to their business, they're still learning. But what they do realize is that they're going to need liquidity, and they may need equity against higher leverage concerns later on in the year or into next year. And we've seen, at least in my markets, companies getting rewarded and having somewhat, I don't want to say unfettered, but pretty low friction access in order to do that. So CEOs are working hard just to make sure that no matter how protracted this is, they are stewards of their corporations, and the most important thing they do is make sure they have the liquidity.
Yeah, I would echo that. And certainly out of the gate, it was all about the balance sheet. It's all about liquidity. I think so many people have discounted the second quarter that you just got to, if you survive it, then that's a positive thing. But I would say beyond just the capital structure, what we've heard from some of our CEOs, and I asked some of my private equity colleagues, this is a chance for a lot of CEOs to rethink their businesses. It's a little bit of a clean slate for a lot of them. So, Russ mentioned supply chain. So how do we think about the supply chain? Should we localize it? Should we kind of, bring it closer to kind of, the manufacturing, the main manufacturing facilities? How do we think about go to market? How do we think about our office space? They are taking this time to take a step back. It's a very, unique time to be able to do that, to really restart your business with a little bit of a clean slate. So we're seeing, more creative thinking, which ultimately, I think, and we'll have a discussion on where we think the economy is going to go, but I think it'll ultimately produce to more efficiencies, better productivity, and I think it'll be better for the economy in the long run. And I absolutely agree with Russ that, as bad as it may seem, companies are looking opportunistically to pick off weaker competitors to find those opportunities to improve their market share.
So industry matters. I still teach the 5 forces model of Porter. So it's something where it's encouraging to hear that there's some value to that. It's interesting. We're all doing Zoom stuff. We're on video now. Some people argue this is going to change how we work. That we're going to do less business travel and more video, less commuting. That seems maybe over the top, but what do you guys think of that? That is business going to change? And when you think of the cost of where you are, Russell, in downtown Manhattan, we could save a lot of money. So it's something where, do you think that we're going to change how we do work because of video and we're going to have less travel?
Yeah, well, thank you for reminding me of how expensive where I live is, and it's only going to get worse with the political wrangling when Mitch McConnell is suggesting that states should go bankrupt, and New York being the democratic state that it is. And you think about, this is a different question. I'm answering a different question, but we'll get to it, I'm sure, about the implications. But you think about the tax bases and what's going to happen to some of the municipalities. It's like you can paint pictures that become quite scary. But I do think it is going to change. We've heard it from clients already. And even if it's a question of, it's just a larger social question as to, you may want to open theaters, you may want to open restaurants, and to the fact of the matter, you may want to open the high-rise towers that people like Brad, Mark, and I work in. That doesn't mean people are going to come back. And that doesn't mean people are going to want to come back. And I think a lot of our clients are telling us, we're happy to do video conference calls, and we're recognizing that we get a lot of business done too. So I do think in the near term, as we start to open things up, I think everybody, and our firm is a perfect example of that, being in over 140 countries, thinking about locally and then globally about how we're going to get people back to work. And I'll tell you right now, all the big banks are rethinking density of buildings, right? The importance of how important or how essential is the term that's being used are folks' jobs that they have to be on site. You can imagine certain trading functionality and other things need the infrastructure that you have. But to be honest with you, a lot of the trading, a lot of the syndicate functions, we and Brad's firm, we've been doing remotely and doing remotely well. And we've had very robust weeks of issuance and real business. But anyway, in short, I do think it will change. And unless and until we get a vaccine, I don't think there's a chance that you go back to where we were for some time. And as we get to the economic questions, I think that's the hardest thing to discount, because the recovery is really going to depend on folks living their lives in a commercial and a consumer fashion that we're accustomed to. And I'm not sure that anybody believes we're going to be back there anytime soon.
So very quickly, Brad, is this going to change how we do business?
Yeah, absolutely. Any shock to the system, it tests the norm, and I think we're going through that. And I think that the whole notion of working from home, I think there was a social stigma against working from home, that you work from home and you were in the kitchen or outside. Maybe you're on the golf course. But I think what this time has proven, that it's incredibly efficient. You remove the whole commute kind of downtime. People are busy. I'm sure it's the same with Mark and Russ. You're busier than ever. And so I think that barrier, that stigma has been broken down. I think there'll be less need to absolutely go see the client or the and I guess every industry will be a little bit different, I think, but this way of interacting, I think, has become much more acceptable and efficient.
Let me just ask you one quick question, Mark. As boomers, you have had a great career because you're great at developing relationships. Does that mean you got to be on a plane, or can you build relationships on video and only occasionally be there?
It's a great question. I mean, firstly, we're all benefiting from massive infrastructure investments that were made before that enable this to happen and actually not crash, which is incredible. I think if anyone asked us, can McGill pull off 1,000 audience on a webcast, he'd go, okay, I'm gonna sell that short. Not a comment on McGill, on the infrastructure. And what McGill has done, by the way, is got all the professors working remotely, keeping the education in front of our great students that are coming up to take on new responsibilities. So just hats off to McGill on what it's been doing. To answer your question, yes, I do think there's a real casualty in this whole thing, which is the ability to build that trust and the service industry is about trust. So that's something that I think all of us are going to have to adapt to in a different way. Perhaps the the next generation of technology coming our way is going to find a way to, going back to our friend Star Trek, and get us to go to different places without getting on a plane. Who knows? But I guess what I would say is I think we're all adapting, and I'm thrilled that the technology is there. The one thing about the U.S., which I think for those in Canada, definitely Canada benefits from it too, is models adapt very quickly, and capital flows very quickly to the models that have adapted. So one of the things I see in this whole thing from a growth perspective is there are going to be new companies, new businesses that come from this that are going to present opportunities that are going to be really, really interesting. And that's in the healthcare space. It's obviously in technology itself and its delivery, but a whole bunch of things that maybe we're going to be 10 to 15 years out that are going to be coming at us much quicker. So it's pretty exciting.
I want to get to the next question about the outlook for the economy, but we're going to have our second poll. So Anne-Marie, if you could put up the second poll about the shape of the recession that we're in. So just give you a few seconds to answer that question. So Anne-Marie, can you show us the results now, please?
Wow.
I couldn't see it. I don't know why. What was it?
It says 60% of the respondents say it'll be a W-shaped recovery, 25% say U, 10% say L, and only 6% say V.
So Russell, do you agree with that, or what's your take on where we're going to be?
I agree with that, actually. I agree with that as much as any observer of the market has their own view. I alluded to it at the beginning, where I think that unless we have sort of a biopharma response, whether that be some kind of curative therapeutic or a vaccine, the risk is too high. This virus is too contagious. I think that's what everybody's saying these days. I'm not a virologist or an epidemiologist, but the fact is, I think there is a burning desire for folks and governments to reopen, and I fear that we are going to have a resurgence at some point, in which case I don't know that we're going to go back to ground zero, but there's real risk of that. I think there's a real risk of that, and I think as a result, you could have access to capital and certainly GDP growth, meaning the consumer has such a big part of that, particularly in North America, that I'm not sure that we will see that come back and have a real risk of having another downdraft before we have a steady recovery.
So Brad, what's your take?
Can't hear you, Brad. My dog was barking, so I put it on mute. Sorry about that. So that doesn't surprise me. I think I've been a W believer for a long time, partly because I want the W to happen so I can invest my money when the market dips again. So I'm kind of hoping for that, and then knowing that we all believe in a W, then it actually happens, and I'll make some money into my retirement. But I think in order for the W to play out, and I made the comment earlier, the fundamentals need to surpass the technicals, meaning the market right now is supported by all this flow of capital into the market. And given what we see on the private side, and I'm sure what Russ and Mark see on the public and private side, there's going to be a lot of damage that's going to come out over the next couple quarters. Unemployment rate, we've clearly seen those numbers, but just the financial earnings are going to be really bad. And if you project where the market is suggesting 2021 earnings should be, it's in line with 2019, which just seems entirely improbable to me. So logic would suggest that yes, a W would be the right would be the right shape. I actually think the government will continue to inject capital into, this pandemic. And while not an option, I think there was an article in the Journal this morning, and I agree with it. I think our CEO said it looks more like a swoosh, a Nike swoosh, in the sense that we've kind of, bottomed out and we're in this kind of slow grind, both on the market side as well as on the economic side. So I'm cheering for the W, but I think it could be a swoosh.
I think the one thing I would add, Professor Moore, is when you look at the real economy and you look at, whether it's some of the programs that the U.S. government, I can only speak to the U.S. right now given I've been here for so long, have put in place to support small business, to support out-of-work employees in addition to unemployment. The fact of the matter is we're, whatever it is, 8 weeks into this. There are businesses, and I can just talk locally, that are closed, that are closing, that they can't, they're not willing to take on the financial burdens because not all of this is going to be forgivable. And so as this continues, and listen, we are all, and I imagine a lot of the alumni on this phone, are in the top 1%, right? And the thing that concerns me about the economy, and I made this point earlier about resuscitation versus rebuilding. The longer this goes, and it's not managed correctly, the implications for the lowest part or the lowest strata of American society, which, and I don't know this for certain, but it certainly looks that way, the despair between the rich and the poor in this country relative to my home country of Canada is very, very different. And the support systems in the welfare state are very, very different. And I am concerned, particularly in the W, where you have social strife and you have other issues that people aren't really foreseeing that are going to have real economic impact and real political impact. That, again, when I talked about at the outset, the economic damage, we are still trying to figure out. Nobody knows. And I do think a W is the most likely scenario. I am very fearful that we do not know what the tertiary and sort of quaternary effects of everything that's going on, despite what the markets are saying, what the real impact is.
Part of the solution has been governments around the world, including Canada and the US, printing money at a furious rate. How's this going to work? Like, can we just print money as much as we want? Or what's the consequences of this from all the stimulus that we're seeing out there? You guys have any thoughts on that?
Taxes, higher taxes. I mean, I think there's a strong view in at least amongst people that I've spoken to, just the corporate and personal tax rate is going to have to go up, just given the income that the government, the interest burden and the income is dropped and will stay suppressed for a period of time. So I think, and that kind of feeds on itself, right? Because with more more taxes, lower profitability, less spending. So I think we're and that's why I think we're kind of in this long grind to get back to kind of where we were in the fourth quarter of 2019. There's just a lot of headwinds. I am not a believer that this will lead to stagflation or inflation. I think rates will stay low. I think that monetary policy would suggest that as you pump more money in, then that should lead to inflation. But I don't see it, and certainly right now we're in more of a deflationary environment. But that the direct ramification of all this, Professor, is I think higher taxes in the U.S.
Yeah, I think I agree, and I think when you think about the implications, right? And when I mentioned, think about, you asked about, is work going to change? Is life going to change? Are people going to be willing to live in the dense metropolitan areas that they're like that we're already seeing some people flee, and that might have been an acceleration of a trend, but certainly people are going to rethink that. And then you think about places like Manhattan, places like San Francisco, and or even Toronto or Montreal, right? The infrastructure, the tax base that is required to run those municipalities is critically important. You can't change the P&L overnight. And if you're reducing the tax base, you're driving folks out, and that's been happening ever since 2016. What's going to happen to the cities? We all remember what happened. Well, I think I've read about it, but what happened in the late 70s, right? In a lot of municipalities, you could be, as you think about the concentric circles of impact, there are a lot of implications that haven't been thought through. So, these are the things that I think most folks in government are struggling with, and that we have dialogue with at the same time.
I'm not sure in Quebec we can have higher taxes, but we'll see what happens, I guess. One of the most interesting things is that China and US relationship is changing through this. When I was a kid, it was Moscow versus Washington. Now it seems to evolve to Washington and Beijing. We've talked about global supply chains maybe coming back home a bit. How do you see the US-China relationship changing because of this events? Shall we start with you, Russell?
Sure.
Oh, sorry. I'm supposed to start with Brad. I apologize.
Go ahead, Brad.
Why don't we start with Karl
Moore? Just to
just to mix it up. I'm happy to start. Listen, I think this pandemic is really accelerating the decoupling between U.S. and China, and that started with the trade wars, and I think it's just it's accelerating that. And I think China has these huge ambitions to be a leader in pretty much everything, but they really struggle with transparency. And this crisis has amplified that issue, and it's actually one of the issues now that in the U.S. at least both sides of the aisle are actually seeing eye to eye on that issue. And so I think ultimately what that leads to is government programs to encourage the change in the supply chain, to nearshore the production, and so I think there's going to be a stimulus program of some sort to encourage manufacturers in the U.S. to do that. I think what scares me about all this, one, it's just not good. Trade wars are not good. I think we can all agree on that. But it could ultimately lead to more localization and across not just between U.S. and China, but more globally. But as it relates to U.S. and China, if things get worse, there could be a dynamic where countries need to actually choose between China and the U.S. A lot of folks trade more with China than they do with the U.S. And so that's going to create a very tricky dynamic globally if this intensifies. But I would say from a policy standpoint, I would expect to see more government incentives to bring some of that supply chain back home.
Russell.
Yeah, I think I was going to say the same thing regarding with respect to supply chains. I think the fact that an area I spend a lot of time is healthcare, and so and tech. And so when you think about some of the nationally important, when you think about the federal stockpile that's more of a planning issue. I think the fact that the U.S. government wasn't as prepared as it could have been, maybe under prior administrations. I think it's really brought home the fact that this offshoring of a lot of key, whether it's industrial, whether it's technological or healthcare, is going to force people, whether it's economical or not, frankly, if it's in the national interest, to be enforcing policy that reinforces those kinds of commercial decisions. And I do think, irrespective of what administration is in office, I think the fact is China is a power that continues to have to be dealt with, and I don't think ignoring and saber rattling as a measure of diplomacy is the best way. Although I do think there will be ways that we're going to have to interact, and I agree with Brad. Obviously, a trade war is not conducive to anything that we do, but I do believe that fair trade and if any fair agreements with the U.S. and broadly, in light of this new reality, are going to have to be reformed.
Mark, you lived in part of Asia for quite a while.
I have I wouldn't say a different view, but a more positive feeling about what we're in right now and where it'll ultimately go. I do believe capitalism will reign. I do believe that U.S. and China need each other. I do think the alienation of China will lead to China, in essence, being more emboldened about their other conquests, whether it's in Africa or in South America or in Southeast Asia. They have a massive economy already. They'll have a crossover in terms of their GDP within the next decade to be bigger than the United States. The United States needs to learn that it isn't necessarily the superpower with respect to the economy that it has owned for many decades. So there's a transitional elements going on here that are not going to be changed by the trade wars. Those are kind of speed bumps along the way. I do think there are some things that are obviously incredibly important that I'm not sure necessarily should be answered on this particular call, which is to deal with transparency and law and all the various things that we care about with respect to human rights. But I think one thing that's having the idea that we will live alone and not actually be great partners over the long term is a lose-lose for everyone.
I've got some questions for some alumni that have sent in. So I'm just going to ask a couple of those questions to you guys. Jeff Matasano, I've read about the most likely time to create an appropriate vaccine and get it deployed, and it's far greater than 12, 18 months that is being promised, it seems. It seems the market is expecting an extremely rare chance to occur. Have you seen a situation where the market was betting so heavily, see the April rebound and into May, on such an unlikely event? Any comments on that?
Well, I'll maybe start. I think I have not seen anything like that historically, and it comes back to the comment I made earlier that I do feel like the government has put a floor on the markets, and that is and when you pump quantitative easing, when that happens, it forces capital into riskier assets. I mean, that's just kind of how how the flow of capital works. And so I think you're seeing that in the equity markets, and I think you're seeing a lot of optimism priced into the market. As I said, I think Mark highlighted it started to go there, but where the NASDAQ is, and certainly where the S&P is priced today, I think the market is because of the technicals. So I don't know. I think you've got to look at the kind of 08, 09 time frame, which I outlined. Maybe it looks a little bit different because of some of the stimulus. But I see a much longer recovery. I think if you get the vaccine, then it definitely starts to look like a V. But that's a long ways out. I think it's just scientifically and process-wise, it's going to take a long time to get a vaccine. And until then, it's all about, Russ said, it's all about testing. It's about reliability of that testing, the accessibility of that testing, and so because that's hard to do, you've got this long tail that we're going to live through over the next 3 years plus. So I'm negative on kind of where the markets are, despite the fact that you've got some technical support from the government.
Yeah, I agree with Brad. I would say, again, just to speculate, if you look at how the market has retraced, I would say, and I'm just making up numbers, 80% of that move in the equity market has been a result of stimulus. And the, I don't say specter, but the promise of the administration and the agencies that they will be there. So, effectively like a put or as a floor, as Brad was saying. The idea that vaccines are behind, I do think maybe is part of it. And I don't know, I wouldn't say it's vaccines per se. I would say it is some part of that, the last bit of the recovery and some of the euphoria that has pushed it up is the fact that, New York passed the modal part of the curve. The fact that it looks like there might be recovery. The fact that there are dozens and dozens of companies and Moderna got accelerated approval to move into phase 2. All these things that are promising, but I think the lion's share of what's supporting the market is not the promise of those. While they're important, those might have single stock impact. I think it's largely what's happening with stimulus.
All right. So Jeff was from Austin, Texas. We have a question from John Rouston. John, I apologize, I'm mispronouncing that, in Richmond, BC. Warren Buffett says he finds nothing attractive to buying the current market and has sold his U.S. airline stocks. Do you agree with Warren? I guess it's hard to argue to disagree with Warren, but do you agree? I really shouldn't have put it that way, should have I? But do you agree with him on airline stocks? And what about the ship cruise industry?
Well, yeah, I think you disagree with the Oracle at your own peril. So I'm not sure I'll disagree with him, but I'll say this. It's all about the uncertainty that everything that we've been talking about on this call, Professor, right? How is society going to respond? I think when you talk about the cruise lines as an example, 2 of the 3 majors have recapitalized themselves. I'll give you an example of how the markets are betting against, as an example. It was the beginning of April, Carnival Cruise Lines did a recapitalization. It was, I think, $6 to $6.5 billion, and a lion's share of that were secured bonds. So, like in the debt side, they did some convertible bonds and they did some equity. I think they tried to raise $1 billion to $1.25 billion of equity, and I think they only raised $500 million. But the secured bonds flew out off the shelves. The convertible bonds flew off the shelves. What does that tell you? People are willing to take, at the highest part of that capital stack, secured risks. They like being backed by the ships and other hard collateral. The equity story becomes very difficult, right? That's a stock that sold off over 30% just in order to get that deal done. So I tell you that story because that's what the market is discounting. So when we think about is it a good investment? Is it going to come back? Play it out. All those companies, whether it's cruise lines, the hospitality businesses, entertainment businesses, they're talking about how much liquidity they have in months. So after a certain financing, they may say, we have liquidity if business doesn't reopen for another 11 months. You have to make the qualified decision as to how do you think society is going to respond? If they get the ships in the water in July or in August, and I think one of the cruise lines yesterday, one of the smaller ones, said they're going to have cruise lines in August. But the fact is, and then what's the capacity? What's the yield going to be on those ships? And so I don't have the answer to that, but I think that's what the market is debating right now, is to say, I believe these industries are coming back. I don't know what form they're taking. So I use that Carnival example as one as just illustrative, that I think there are backers of the capital structure of those companies, and it just tells you what the risk tolerance is around those businesses, right? And so I do think, is there a future for airline travel? There absolutely is. Do I think it's a great equity investment right now? I really think that depends on what you're willing to underwrite to as to how quickly they recover. And that's for individuals to decide themselves.
Up here in Canada, there's debate about Air Canada, WestJet, and should we support them? So it's an issue we're facing up here in the north as well. Brad, anything to add?
Well, it's the right debate, because I think it comes down to what Russ was saying around capacity, and I think I agree with what Russ said. We're going to go back to, I haven't done a cruise, but people that do cruises are going to go back on cruise ships. People are going to go back to theaters. People are going to go back to restaurants, and people are going to travel again. So all of that is going to resume, but it's a capacity issue. And if you think about not just those sectors I just mentioned, but other sectors, the majority of profitability comes from that last 25% of capacity. So if we're operating at 75% capacity, a big part of the market's come back. That's great, but it doesn't mean it's profitable. And I think that's what ultimately leads to consolidation. And I think you're just going to see the market shrink a little bit, and maybe WestJet, merges with Air Canada, or maybe one of the major U.S. airlines goes away, and so we get capacity back to where it's profitable.
You just have a couple minutes left before we're done.
I've been very. Yeah.
Sorry, I apologize. One last thought. You had a last thought there, Brett.
Oh, I was just going to say, we saw surveys a couple of weeks ago that 80% of consumers were willing to go back to theme parks. This is like in the middle of not the middle, but towards the pretty elevated cases of coronavirus, and 80% of the population wanted to go back to theme parks. People will go back, but just not 100%.
Just have a couple of minutes left. How has the pandemic affected you personally? How is your life a bit different? Are you working? I assume you're working less, Russ, because you're at home.
No, quite the opposite, actually. Quite the opposite. It's I think one of what Mark or Brad alluded to it earlier. I'm working harder than I ever have. I mean, it's because you're accessible. People recognize you're not on planes, and it's almost hard to detach yourself because everything is remote. So you're immediately accessible, and so I am working harder. I think to Brad's point, it is more efficient, but it is hard to turn it off, right? And particularly if you're related to the markets and the fact that I'm in the advisory business, so I have clients, and they know that I'm accessible. So that's there's good and bad with that. But I think personally, aside from the fact that I get to see my kids a lot more, which has been the silver lining of all of this, and my kids are teenagers, so I recognize it would be a very, very different story if they were 2 and 5 years old. But I think what I would like to talk about is being a manager. I think being a manager of people and recognizing that I have people that report to me who are 22 and 23 years old, who are having their first job out of college, who had roommates that live in the East Village, and their 3 roommates have gone home to their parents' home. But this one of the kids is families in China. And so they are there at their first job by themselves in an empty apartment, working 17, 18, 19 hours a day. And that, I think, in terms of what I worry about most is our people, and that we all don't have the same support systems. And that's somebody, think about it, that's a 23-year-old who has a job, right? There are lots of swaths of this economy who are in similar situations that have no job and may not be able to make rent. So in terms of what I'm dealing with, it's more about managing our teams, managing our people, and staying connected when nobody's together. That's probably the biggest challenge for me as a manager.
Well, we're going to run out of time in about 30 seconds. So I just wanted to thank Henry Cote and David Simcox from McGill for setting this up and organizing it so well. And I'd like to thank Brad. It's been 20 years. You just get better all the time. So delighted that I had a small little part to do with that. Nice meeting you, spending time. Mark, say hi to Erica and Monica and Carl for me, and hope you're enjoying being in Mount Tremblant. And we have an event on May 26th at noon with Chris Reagan, who's an economist, very well-known economist, who's now the head of the McGill School of Public Policy at McGill, a new school that just got started about a year ago. A lot of excitement about that. And so we look forward to joining us then. Thank you for joining us today. And thanks for your time, guys. And look forward to seeing you again the next time we're around.
Stay healthy. Thank you.